Good morning, good afternoon now. Good afternoon, everybody. I'd like to call the Finance Committee meeting to order, please. Doug, are there any public comments
No,
this
sir,
morning?
there are no public speakers.
Okay, then the first order of business is the approval of the minutes of our December 17th finance meeting. A motion, please. Second, please. All in favor? Any opposed? Minutes are so approved. Doug, would you please take us through the committee work plan?
Sure, there's one change to the 2013 work plan. The action item, approval of supplemental resolutions authorizing refunding bonds, was presented to this committee in December 2012 instead of January 2013. That's the way we're going to do it going forward, so it'll be every December now instead of January.
Okay. Let's see, Budget Watch, Doug, you want to do that next, please?
Sure. In January, January Budget Watch is the first look at 2012 results, and it captures some very preliminary results for revenues and subsidies. At this point, the expenses are too premature or unavailable, so they're not really meaningful. We will look at those next month in February. So looking at revenues, operating revenues and subsidies, compared with the November forecast, revenue results were overall unfavorable. However, that was due to the unprecedented impact of Tropical Storm Sandy. Because of the impacts being so profound there, within Budget Watch, you'll notice we compare the results with and without the impact of Sandy. In raw numbers, combined passenger toll revenues were $60 million lower than the November forecast. However, $98 million of that was a result of Sandy impacts. So excluding that, we have a $38 million favorable, what we think is a $38 million favorable revenue and toll performance, and that's due to higher utilization from an improving economy and favorable weather during the fourth quarter. I'd also like to point out that the MTA anticipates an eventual substantial recovery of its Sandy revenue losses from insurers.
Doug?
Yes, sir.
Substantial meaning 90%?
Well, in that vicinity, but you know, that of course will have to be negotiated.
Yeah. Yeah. And that includes the mandated free days that were given to the public, of course.
No,
That doesn't include
it's all to be negotiated with the insurers, okay? So again, at this stage, we can't say exactly what will be covered and what won't be covered, because the other thing to recognize that this is supposed to be determined based on the net effect to us. So to the extent that we had lower operating expenses because we weren't operating, they would take that into account based on whatever revenue we didn't collect. So we can't really say what will be the net result from insurance. But again, it will be something that's evaluated. We're keeping track of all the costs and we're keeping track of what we think are the lost revenues, but it still will have to be subject to negotiation with our insurance companies.
Okay. Moving forward, the payroll mobility taxes, MTA aid, PBT, and TOA taxes all came in virtually on target. The other performance of note was that real estate transaction collections, particularly the urban tax, were very strong in December. These receipts were $23 million favorable for the month. So if you were to sort of sum up revenue and subsidy performance for 2012, again, unfavorable to the forecast. However, excluding Sandy, the results were favorable. I'd also like to point out that in January, we have also strong real estate results. They were $29 million favorable for the month. But we want to caution you on that because they're based on one-time transactions. That's the nature of these taxes. So the very end of last year, the November and December results were very strong, and some of that we feel are due to expedited transactions, knowing that the tax rates would be going up in 2013 on capital gains. So we'll be keeping a close eye on those numbers. Any questions?
Pat, could you do the Finance Watch, please?
Okay. Good afternoon. Finance Watch appears on Roman numeral 4-1 of your committee books today. We have a couple transactions to report. The first being a refunding on the Triborough credit. This is a total of $653.9 million of Triborough subordinate revenue refunding bonds and $257 million of Triborough general revenue refunding bonds, what we call the 13A and 13B. We were originally going to bring this transaction to market in December, and literally after we printed the POS, the market effectively closed up on us, and so we took a pause and we waited till things looked better. And working with our financial advisor and our underwriters on this, we came back to the market in January 11th, 2013. This was notable as it was the first large transaction in the tax-exempt market in 2013, and we were very pleased with the results. As you can see here, we refunded a total of $996 million of bonds for a total net present value savings of $157.85 million, or 15.84% of the combined par amount of the refunded bonds. In the retail order period for the transaction, we saw very strong interest from retail investors, over 800 million of orders for the bonds that were offered, which was really quite dramatic. The following day for institutional pricing, we saw a strong reception from institutional accounts. And so, as you can see here on Roman numeral 4-2, we provide statistics for each of the two components, and then on a combined basis. As you can see here, our all-in true interest cost was 2.93% for the issue, with an average life of 12.9 years. And our lead manager on this was Jefferies, working with Goldman Sachs and Loop Capital as co-senior managers. Next, on January 17th, we issued $500 million of transportation revenue new money bonds, our 2013A issue. And as you can see here, this also generated a very good result with an all-in true interest cost of 3.79%. We had strong reception from both retail and institutional accounts during the order period. This was managed by Citigroup, which is our senior manager, and MR Beal & Company as special co-senior manager. I would just note there are two fuel hedges that we don't have in the book here that we'll have in the book next month. We bid out competitively a fuel hedge on December 19th for $15.98 million. That resulted in an all-in cost of $2.87 a gallon for 5.5 million gallons of fuel. That was won by J.P. Morgan. And our second one was just done last week on the 23rd, $14.3 million for an all-in price of $2.90 a gallon, total of 4.955 million gallons, and that was won by Deutsche Bank. And those will be in the book next month, just for the record to reflect that. That concludes Finance Watch. If there's any questions, I'm happy to take those now.
One, last month I had raised the issue of the Sandy-related financing, and I understand that the governor's office responded with respect to that issue.
Yes, we are not going to pay any bond fee for the Sandy-related financings.
Okay, so that's good news.
Yes.
Okay, and secondly, you had mentioned another good news situation to me the other day. I'd like you to take a victory lap.
Okay. Some of you may recall that we have these leverage leases outstanding.
You want to do that? Because the next item is...
Okay, we can wait, and we have a leverage lease, and we'll do it then.
The next item on the agenda is exactly that, so...
Okay, I just want to make sure that good news gets out there.
Right, so don't worry, Bob will let the good...
Do it twice.
We would, except we're running late. All right, go ahead. So is it okay, Alan? We're just going to go, all right, okay. So the next thing is the leverage, termination of leverage leases. Okay.
Okay, I'll do that.
So now you want to give him the good news? Give him the good news, and then he'll do this.
All right. As you recall, we have these leverage lease transactions that are outstanding, which basically were entered into over a number of years. And the benefit to the MTA was that the proceeds of these leverage leases, the net proceeds, I should say, after we took care of all the ongoing obligations, was used for the capital program, and it was quite beneficial. A lot of money came into the capital program. But as we said, these transactions are such that the benefit comes up front and there's never any more upside on the transaction. And we had a transaction that we asked for the board's approval, 3 transactions, in fact, to terminate. at the end of last year, and the board gave us permission to terminate those transactions. And a key motivating factor is that the party that was providing the investment contract and also that was providing certain insurance on the transaction looked like they were going to be downgraded or potentially downgraded by Moody's. And so we asked for permission to terminate the transactions, and we terminated that roughly $1 billion transaction for $2.8 million, significantly below what we thought it could cost to terminate. Moody's did take action and downgraded the insurer. They downgraded it 2 notches. The impact to the MTA, if we had not terminated that lease, would have been significant. We would have had to have written a check for about $57 million for the investment agreement, money out the door, never to come back, and we would have had to deliver U.S. Treasury collateral of about $255 million that would have come out of the capital program. So net, we would have hit the capital program if we had not terminated the swap by about $312 million. We appreciate what the board did. Very complicated transactions, but in authorizing us to terminate transactions when it makes sense. And again, this was the greatest risk and exposure that we had. The other transactions that we still have exposure, but nothing like this. And we are bringing to you today for an action the termination of a Sumitomo lease. This Sumitomo lease is about $75 million. It's there. We will terminate it without cost. There won't be anything. But again, our risk will be gone forever. We received about $7.7 million when we entered into this transaction. It goes till about 2022. By terminating it, again, without cost, there will be no downside for us. So, it's Sumitomo Capital Markets. It's a financial institution that was the other side of the trade. Yes, it did.
Sumitomo is the lender.
Sumitomo is the lessor.
Who's the lender?
It's an affiliate of Sumitomo, I'm sure. If you recall, these are transactions which, in economic substance, should be totally defeased, if not, legally.
So, so we're asking that the MTA Board authorize the MTA Acting Executive Director or the MTA Chief Financial Officer to terminate a qualified technological equipment leverage lease with MMBC Capital Markets Incorporated of automatic fare collection equipment having an asset valuation at $74,980,000.
Wait, Bob,
So we have a motion?
second. Can I ask a question?
Sure.
Chairman, thank you. So do you know the rating of Sumitomo and whether they're under potential
No.
threat of
No.
credit watch or anything, downgrade?
Yeah, no, I don't know. This, again, the issue here is different from the issue previously. It was the guarantor. Here we have, I think, U.S. Treasuries that are already put up as collateral on this, so it's not.
What are the treasuries worth now, do you know?
I don't know. But the treasuries are sufficient to fulfill our obligation, according to the contract, so.
Okay, so we have a second and a motion. All in favor, please? Any opposed? Motion carries. Okay, Doug.
Okay, next we go to reports and information items, and the first is a special report 2012 year-end review that Pat McCoy will be giving.
Yeah. I think we just have to turn on the projector here, but everybody should have received this color copy and with your committee materials. We'll just go through that quickly this afternoon. Again, this is a report that's required in the work plan, summarizing all of our financing activity in the prior year, in this case 2012. So we begin on page 1 here with just a summary of our portfolio. Total debt outstanding now is $31.2 billion, of which 83% or $25.8 billion is in the fixed rate mode.
Yeah, I think this is really something that's very important because we've been talking about locking in rates here because I think you have to be practical. Rates can only go one way at this point. I mean, there's low. I think most experts will agree, as they can get. And if you look at it, out of what, $31.5 billion worth of debt that the agency has now, almost 26 billion of it is fixed rate with an average life duration of about 19 years. Is that correct, Pat?
That's
what I'm
correct.
saying?
That's right.
So what you've done here is true. It may be costing a little bit more in the short term, but I think we've really locked in. In effect, we've taken a real long-term mortgage at these really low rates. And I think that's really good that we've been working towards so much of our debt being really fixed for a long term. And I think that's what's important. Am I right, Pat, about this pipe
That's
chart
the real
that you
that's
have
the real
here?
takeaway here is that we've locked in low cost funding for the majority of our capital program through issuing fixed rate bonds.
Rate.
The average rate of our fixed rate portfolio is, we haven't recalculated it from our last refundings. I want to say we're around 4.25%, but I can provide that next month. You know, that's all, you know, for the fixed rate portfolio.
But you got a lot of 30-year. You got a lot of 30-year paper in there too.
Right.
Pat, how does the $31.2 billion number compare with the number on December 31st, 2011?
Fair question. I don't have that number handy. It's probably going to be a little bit lower because we actually did some refundings, although with the new money.
Right. As a practical matter, we repaid about 650, I think,
$650
million dollars of debt
Yeah.
just from operating revenues, paid it off. And so then there were refundings that we did, but there was new money that we issued. So we're rough. I think we were about $30 billion, you know,
So we've gone up some.
about $1 billion. But we'll give you the exact numbers.
Okay, thank you.
What is the market supporting now? 3%?
What is the market supporting?
Yeah, what are you able to issue paper on average for?
Sure. Well, you know, this issue that I just reported was, you know, the transportation revenue bonds was an all-in cost of 3.79%. So that's a traditional new money issue, $500 million. So
If the average of the paper that we have out now is at 4%, would there not be some sense into trying, as Andy pointed out before, to get into the market and refinance that at a lower rate?
Well, as the report's going to show, we had a banner year in refundings in 2012. We refunded a substantial amount of bonds, all for savings, and so we've taken just about every opportunity off the table that we could take off, given what the market provided.
Let him do his report because I think it's going
But-
to. When you see these charts, I think your questions will be answered.
So, and you know, I was estimating that number. I'll give you the precise number as soon as possible on that. So, so here you see the portfolio in terms of how it's been issued: synthetic fixed rate debt, variable rate commercial paper, and of course fixed rate, as we talked about. Turning to the next page, this shows how the debt is dispersed by resolution, with the majority of it being under the transportation revenue resolution, 17.3 billion. The dedicated tax fund here in the lower orange slice, the two green slices being Triborough Senior and Triborough Subordinate, and then that thin little sliver of certificates of participation for our repairs at 2 Broadway. Turning to page 3, we knew this was going to be an important year in terms of refundings, and we're always actively speaking with investors and the rating agencies. This year was no different, but we knew we had a lot to do. So in May, we went out on a national investor roadshow. I think I spoke about that in June. This just kind of recaps all the different outreach that we had with investors through the year. These internet roadshows provide us an opportunity to speak directly with investors, to present our financial condition, and to take their questions. And as you can see here, on November 5th, we were right out speaking with investors after the Hurricane Sandy event, giving them the best available information that we had at the time, and then we followed up on December 7th with subsequent information. I think we've received very good feedback from investors that this is just what they need. We're very transparent and open with the investment community, and that enables us to have a good reception for our bonds when we come to the market. So turning to the next page, I'm not going to read through this. This is just for your takeaway. Um, Bottom line here, 2012 saw historically low interest rates throughout the market, and we saw in late November the lowest points here for the 30-year Treasury and the 10-year Treasury, or the 10-year, what we call the AAA MMD, and the 30-year AAA MMD, 1.72% and 2.83% respectively. So that just gives you a sense of the market environment that we're issuing into. So it was a very, very good year to do the refundings that we did. So if we turn to the next page, this just summarizes our transactions. Not unusual here for us to issue about $2.2 billion in new money, $2 billion of it in fixed rate mode and $150 million in floating rate notes, or FRNs. $5.3 billion in refunding bonds, and that's the real major effort here that we took in 2012. As you can see, $5.8 billion of fixed rate bonds were called and refunded for savings. This generated net present value savings of $995 million, and we structured this to provide capacity for the 2015 through 2019 capital program.
I think Pat's done really an outstanding job. I know we've all worked with Pat over the years, but this is a massive program that he undertook, and this, with our advisors, I mean, this is not an easy thing to roll over this kind of debt and replace it, Pat, and I think that's a hell of a lot of savings. $1 billion present value savings is real money here for the riders and the public, and I think they've done a great job, and they continue to do a good job, as we see with the issue that's just happened in January. Yeah, well, so this is real big money for us.
Thank you, Mr. Chairman. Thank you. It's worth noting that the finance team, the legal team, our financial advisors, our underwriters work well together, and really it's a good working group, and credit goes to all of them really as well. So. Thank you.
Under Bob's direction, this has been a major program, major savings for our riders. Bob really also, I forgot to say, Bob, you really deserve a lot.
Thank you, Andrew. Thank you. The third category here on the sheet is we note $2.1 billion in remarketing of tendered obligations, and this is just the ongoing management of our variable rate portfolio and our synthetic fixed rate portfolio. And as you can see here at the bottom, we retired $645 million of debt just through our normal amortization. In total, in 2012, we had 25 separate transactions with a notional amount of $9.5 billion. So it kept our staff and our advisors very busy. Turning to the next page, you can see just the squiggly line here going across shows the 20-year benchmark averaged 2.65% for the year, and then each of our fixed rate new money issues. Turning to the next page, we summarize in more detail, a little bit more detail on our 2012 refundings, and you can see each transaction. We've reported all these transactions to the committee and to the board, and this gives you the detail on each one of those. Turning to the next slide, we show where those refundings occurred, and again, what in this case we use the 10-year benchmark because the refunding transactions have a shorter average life. That benchmark averaged 1.8% for the year. Again, just a historically low interest rate year. That can't be emphasized enough. And you can see the highlights of each transaction there. Turning to the next page, this summarizes our remarketing results. And I would just, one of the key things here, Andrew, that you had mentioned earlier is, taking advantage of these low rates in the fixed rate market. And as you can see here, we converted $527 million from a variable rate mode into a fixed rate mode. Again, just taking advantage of those fixed rates, getting out of variable rate, and you can see the details on each transaction there. We did some conversions to the index mode, or the FRN mode. We had some remarketings in FRN mode, and then just remarketing variable rate demand bonds with new liquidity or credit providers there. And you see the summary there of the providers that went out and the new ones that came in. Turning to page 10, The variable, just a little more detail on the variable rate portfolio management. Again, we have $2.9 billion in outstanding variable rate demand bonds, comprised primarily of weekly resets, but also some $700 million of dailies. At the end of 2012, this portfolio was smaller by $742 million. Again, taking advantage of those fixed rate opportunities, converting into lower cost FRN mode as well. We are always working on our portfolio of liquidity providers here. We increased to 18 and entered into some new agreements with new providers, high quality names like PNC Bank, U.S. Bank, and as well as 2 pension funds, CalPERS and CalSTRS.
I see you still have $325 million in floaters or auction rate securities.
That's right.
I thought you were going to retire that stuff.
We sought authority from the board to do just that, to run a tender process on the 2002B bonds under the TRB credit. There's about 200 million of those outstanding. Quite frankly, even though those bonds are failing in the market, they're failing at very low absolute rates, around 0.5%. So, you know, our view, quite frankly, on that is we're going to take advantage of that, of what the market provides in the form of those low rates, until we start to see a change in market dynamics that would compel us to then undertake the tender offer or refunding of some type to take action on them. But at this point, given what the market provides, we're going to leave those where they are at the moment.
But doesn't the market deprecate our financial position by continuing to have this stuff outstanding so long when most other institutions have withdrawn or gotten rid of their auction rate stuff?
You know, I'd say no. I don't think that's the case. A number of these bonds continue to be to be outstanding in the market. Many issuers are finding that from time to time the auctions do show some movement of bonds from one investor to another. So you know, we certainly have not had any feedback of that nature come back to us, and I think if it were truly a sentiment out there, we would have heard that, and quite frankly, we haven't.
And again, the City of New York continues to have some auction rate securities outstanding. I think what we've tried to do is we tried to reduce the amount that we have outstanding to a reasonable position, and to the extent necessary, we could get out of these by refunding them with long-term fixed rate debt. We've also been open to inquiries by holders of these bonds who would like to put them back to us and sell them to us at a discount. And to the extent that we can buy them back less than par, we've been open to that as well. So we are watching it. We will take action, you know, at the appropriate time. But the rates are still attractive relative to some of the other variable rate products that are there.
Yeah, just on the subject of the refunding, as I read this, it's $5.8 billion in refundings that we did last year?
Correct.
Okay, and am I also correct in that we paid no fees to the state of New York for those $5.8 billion per this board's request and the Governor Cuomo's
That is correct.
commitment? What was the actual value to us of that?
I think we estimated that value at about $44 million, the fees would have been approximately $44 million.
It's roughly 0.8% as the par amount.
Okay, that's a considerable sum of money. Okay, thank you.
Alan, you should know that we were the second agency to get that. The first was the Dormitory Authority. I thought you'd like to know that.
Well, we got it, and you know, I think you know, we found our counterparts at the State Division of the Budget to be very cooperative with us and helpful in getting that waiver in place.
Okay. The last leg of that is to get the waiver now for new monies going forward, which, given the state of our capital program over the next few years, could also be a considerable amount of money.
Yes, indeed. Okay, so moving on to the next slide here. This just provides a snapshot of what we anticipate in the current year. In 2013, we anticipate about a little over $2 billion in new money. as we've been discussing in past meetings, $2.5 billion for Sandy-related short-term financing, a little over $1 billion in remarketings, and about $1.1 billion in refundings. I would just note that the Q1 refunding number of $996 million, that's the transaction I just reported on. That's the TBTA deal, so that's locked in. The $195 million in the fourth quarter are bonds that will be currently callable in the fourth quarter. What that doesn't anticipate are opportunities where we might want to take advantage of an advance refunding. But again, we've done very well by just waiting for bonds to become currently callable and taking that the savings off the table. If you turn to the next slide here, this just provides a sort of a quarter-by-quarter snapshot of, this is the financial plan horizon, apologies, 2013 through 2016 issuance. And you see here the MTA credits are represented in blue, Triborough credits in green, and then, of course, the Sandy financing in gray. Turning to the next page, this just provides a summary of our remarketing outlook in 2013. It's hard to see here, but in the green, those transactions highlighted in green, we expect to have to do something with this year, either find a new liquidity provider, remarket to a floating rate mode, or fixed rate mode. And so we'll be reporting on those as the year goes on and let you know what happens there. If we turn to the next page, just a kind of a summary on fuel hedging. We continue to work with this program that provides budget certainty by reducing exposure to that volatile commodity in our budget. We're currently hedging about 50% of the ultra low sulfur diesel. In 2012, we entered into a total of 11 hedges for 146 million, covering about 50 million gallons of fuel. And as you can see here at the bottom, we provide a summary of our exposure to the various counterparties that are active in this portfolio. Bank of America, Merrill Lynch. I would just note that they're no longer meet our rating requirements, and so we're not active with them anymore. But then Deutsche Bank, Goldman Sachs and Company, and J.P. Morgan through their energy subsidiaries. There's a number of appendices here. I'm not going to go through those. They're there for your information, and I'm happy to take questions now or at any time in the future. If you as you go through this, there's a lot of detail here on the portfolio. I would just note that we didn't include the asset lease terminations in here because those have been an active discussion topic at the meetings. But I would just point out that those have really been have benefited from significant effort by Jerry Page and Paul Acera, who've done great work in getting those under control and terminating. So happy to take any questions now.
Pat, that was an excellent report, and again, thanks to you and, of course, Bob Foran for a great job done here.
Thank you, sir.
Doug, you want to take this? The overview, I understand, is just out here.
Yeah, the February plan
Right.
Obviously would normally be presented and distributed at the February meeting, but with the new board schedule, there isn't one. So we're still going to distribute it next month. We're still working on it, on finalizing it. But we do, have a pretty good idea of what that's going to look like. So I just wanted to give you a heads up on it. So next month when you get it, you won't be blindsided. Now the purpose of the February plan is to incorporate the board-approved actions and technical adjustments into the November financial plan budgets and forecasts, and then we establish 12-month allocations of the adopted budget, which allows us to do reporting in 2013. As you recall, there's certain items in the November plan that we capture in volume 1 below the line, and we do that in order to highlight those items. So come the February plan, we take those items and we move them into the baseline, into agency budgets. There are also some items where there are reforecasts where the agencies haven't had a chance to, where we have cutoffs and deadlines, and we say, okay, we will do that on a topside basis. So we have where the baseline, the consolidated baseline captures it, but the agency budgets don't. So this allows all those sort of technical corrections and moving from below the line to above the line, and then once agencies put these numbers and programs into their systems, there's little technical adjustments. So the bottom line is what you'll see in February is very similar to what you've seen already. A couple of items of note, we are changing within operating revenue, advertising revenues, which are managed and controlled at the headquarter level. Currently, those revenues are reported at the agency level, at the the physical location of those assets that generate the revenue. We are going to be moving them into headquarters on a zero-sum basis. So, in the case of an agency losing revenue, headquarters will pick up the revenue, but the agencies will be made whole on a subsidy basis. The other changes are very technical in nature, really timing and that sort of thing. So the bottom line is very little change from what you've seen already. Sure. I'm going to talk about headquarters procurements. There are 12 headquarter procurements, 1 non-competitive and 11 competitive, for a grand total of $29,206,000.
Okay, a motion, please. A second, please. Okay.
We have a question.
Would you please record me as voting no with respect to the item on page 7-8, automated vehicle and location management systems? I responded to why I was voting no at the meeting, the committee.
Oh, that's in Long Island Railroad. That's in Long
Okay.
Island. We're not there yet.
Okay, so all in favor?
So we're still talking about headquarters.
Yes, I have two questions. One on the e-procurement, and one on the multi-agency Just to confirm, the e-procurement only obligates us to use them when we decide that e-procurement is in our best interest to do. It doesn't obligate us to use e-procurement on all of our procurements. Just whenever we decide to use e-procurement, we do.
Yes.
Okay. And then, I'm glad they're giving us lowest pricing, but probably also their largest volume. And then on the, I'm sorry, the multi-agency competitively bid wireless on page V-13. Just want to confirm that the police were active participants and agreed. I know that they're on the committee, but I'm not sure how the committees work. They agreed with the selection and they're content
Yes.
with it? Yes. Okay, thank you. That's it. Thank you very much.
Okay, so all in favor? Any opposed? So moved.
Okay, there are no items for Metro North. Next would be the Long Island Railroad. There are 4 competitive procurements for a grand total $63,173,000. 1 joint competitive modification with MTA Capital Construction, 1 joint competitive RFP with Metro North, 1 multi-agency competitive modification with Metro North and B&T, and 1 competitive RFP. And Mr. Murdler.
That's the one I vote no on.
Okay, well, we're going to take the vote now.
Right,
So we have a motion. All in favor? We need a second, I'm sorry. Seconded. Oh, all in favor? Opposed? One
Just
in
on that
opposition.
7-8.
Okay, so moved.
Okay. Next, we have New York City Transit MTA bus operations. There are 3 procurements for New York City Transit, 1 being a walk-in, which you should have on your desk. The estimated grand total is $12,801,000. 2 non-competitive modifications, and the walk-in is a competitive large modification.
Okay. Second, please. All in favor? Any opposed? So moved, done.
Next is bridges and tunnels. There's 1 non-competitive multi-agent procurement with Metro North, Long Island, and MTA Bus, and 1 competitive procurement. The grand total of those is $5,722,000.
Okay. Motion made. A second, please. All in favor? Any opposed? So moved.
There are no items for FIMTAC. you'll find consolidated financial reports in section 11. And real estate agenda is next.
Jeff, go ahead.
Thanks, Andrew. We have 6 action items for your consideration this month. As always, each is the subject of a staff summary. Perhaps I'll just highlight 3 quickly. The first is sale of property in Garden City to Nassau County. This is an example of our ongoing effort to respond opportunistically to chances to unload surplus property. This is a former siding. It's useless to us and would literally be useless to anyone other than Nassau County. We're getting full appraised value, nearly $100,000 for this, and also relieving ourselves of maintenance obligations. So we're pleased with that result. Yes, Chuck?
Any chance we could use that to leverage Nassau County to pay what it owes us?
I'll only say that we took thoroughly into account the sort of existing state of play with Nassau. At the end of the day, this is allowing a federal grant to go forward for an important CNG facility. We think we got top dollar for it, and didn't feel, in the end of the day, like a leverage point. But I take your point. The next item I wanted to highlight is our procurement for ATM machines, or rather a request for proposals for ATMs for both Long Island Railroad and Metro North. This is going to represent a 33% increase in overall revenue and a very significant expansion of the fleet, if you will, of ATMs as an amenity for Metro North customers.
Could I please be recorded as recusing on this item?
Okay.
Did you get a fair amount of competition on bids for that?
As the staff summary indicates, we got bids from the incumbents, which were Bank of America and Wells Fargo, respectively, for Long Island Railroad and Metro North, but neither of them was interested in expanding the number of ATMs. We had another proposal that from a less known financial institution that was not prepared to guarantee any financial results, and Chase was far and away the most active bidder, if you will. The last item I want to mention is a relocation of our subway maintenance group facility from Westside Yards. That is due to the impending transaction with Related in Oxford. We need to clear the way for redevelopment, and also a very pressing concern for the city and the Friends of the High Line as they proceed with their third phase of the High Line project. This was a very tough search for us. Andrew Greenberg did a great job on this for us. We had very few suitable locations. It needed to be in Manhattan by nature of the activity. As it is, we got a great result. It so happens that the warehouse that we've identified in Manhattanville is controlled by our transit billboard contractor, Van Wagner. The upshot is that we are going to have cost-free occupancy of this garage and a piece of the action to the extent that the billboard revenue exceeds the ground rent that's to be paid by Van Wagner. So a very handsome result. If there are no questions on these items, then I'd ask for approval of the 6
Motion, please.
agenda items.
And a second, please. Carl, second. All in favor? Aye. Any opposed? Jeff,
Thank you.
you're done. Thank you. Now we need a motion, please, to adjourn the Finance Committee meeting. Second, please. All in favor? Aye. Thank you. See you at the board meeting.
I saw an ad on the subway.
This is it?